In today's video, we're going to take a look at a company called Street Specialty Lending, ticker symbol TSLX. This is the 11th video that's a part of my portfolio series where I'm doing an in-depth analysis on all 31 stocks currently in my own portfolio. If you're new to my channel, my primary focus is on income investing and dividend growth investing with holdings that offer at least a 4% yield. As I'll say in every video in this series, this isn't done in any particular order, so just because this video is 11th in this series does not mean that this is my 11th favorite stock or my 11th largest holding. Also realize that because I own all these stocks, I am biased towards them, so do your own research before making any investment decision for yourself. Also, let me know if there's any improvements to this series that I can make going forward. Feel free to check out last week's video, which was on the PIMCO Dynamic Income Fund, ticker PDI, which is a high-risk 14% yielding monthly dividend-paying fund. Logging into my Vanguard account, which is where I do all my dividend investing, as of the making of this video, I currently own 206.164 shares of TSLX. Their stock pays quarterly dividends, with their last being for 46 cents per share. With the number of shares that I hold of this stock, I receive roughly $94.84 a quarter from this stock, and divided by 3, that comes out to $31.61 a month in dividends. Street Specialty Lending is a business development company that provides senior secured loans, including first-lien, second-lien, and unitranche loans. They offer unsecured loans, mezzanine debt, and investments in corporate bonds and equity securities. The company invests in a wide range of different industries, including business services, software and technology, healthcare, energy, retail, manufacturing, and industrials, among several others. They invest in larger companies with an enterprise value between $50 million and $1 billion or more, and an EBITDA between $10 million and $250 million. Street Specialty Lending was founded in 2010, and they were launched by Sixth Street, which is a large global asset manager. It was around the early 2010s when a lot of financial institutions decided to launch their own BDCs, which was kind of unusual. For example, Goldman Sachs launched their own BDC in 2012, Triple Point Capital launched Triple Point Venture Growth in 2013, and BlackRock launched a second BDC in 2012. Sixth Street currently has over $65 billion in assets under management across different sectors, including real estate, infrastructure, insurance, and agriculture. TSLX is a high-yield dividend stock that you really don't hear too much about, despite consistently being an excellent grower. If we look at its total return since its IPO with dividends being reinvested, we can see that it's almost always been the S&P 500 over time. Their stocks provided an average annual return of 13.02% since its launch, compared to the index's 11.82%. On top of that, their stock always continues to not only grow its dividend, but also pay a lot of special dividends. It's rare for a stock that yields this high to outperform the market by this much, so let's go ahead and take a deeper look into TSLX and see what sets them apart. Street Specialty Lending is a business development company, which is an organization that provides financing to small and medium-sized businesses. A BDC helps firms grow in their initial stages of their development, and sometimes less often, they'll also provide financing to rescue distressed companies. So in a way, they're kind of similar to venture capital funds, only anybody can invest in them as opposed to just accredited investors. BDCs are required by law to pay out 90% of their earnings to shareholders in the form of dividends, which makes them great for income investors, or sometimes, as in TSLX's case, people who want to beat the market. When it comes to analyzing these types of businesses, there's a lot of different things you should look at. We'll start by looking at their debt portfolio. TSLX currently has a portfolio value of $1.5 billion, which currently makes them the 16th largest BDC in the sector. The larger the BDC's portfolio, the more this helps in terms of diversification, which is important for these companies. Just like us as individual investors, you don't want most of your money invested in just a couple of holdings. Rather, it's best to spread out your investments across different company types, sectors, sizes, and so on. A BDC that invests in businesses should have their money spread out across different industries to protect itself, especially if any of those industries are cyclical. Fortunately for Sixth Street, they've got their investments spread out pretty well, although it's mostly focused in the service sectors. Their largest industries include the internet service sector at 15%, business services at 12.7%, financial services at 11.8%, and retail/consumer products at 11.5%. They also have investments in different areas like education, communications, automotive, and so on. We can also see that 90% of this company's investments are in first-lien debt. First-lien debt holders are first in line to receive their principal back if the borrowing company goes under. This pyramid I've shown in the past does a really good job in showing where each type of debt has its priority. Senior debt, aka first-lien debt, is first in line, followed by subordinated debt, preferred equity, and common equity. In the event a company goes bankrupt, common stockholders at the very bottom rarely get their investment back. That's because unlike common equity, senior debt is secured by collateral, or in other words, assets owned by the company. If one of Sixth Street's debt holders can't repay the money that they borrowed, then TSLX is going to be first in line to receive the proceeds from the sale of the company's assets, like their buildings, computers, and so on. The recovery rate is usually pretty good for this kind of debt. It's unlikely that if a major corporation goes under that TSLX would be able to recover all of their money, but this kind of debt has a pretty good recovery rate. You can also see TSLX holds 8% of its portfolio in equity/other. Equity investments provide more opportunity for growth for them, but it comes with more risk, as you can imagine. When it comes to their dividend distributions, TSLX has a great track record. They've been able to grow their dividend distributions, although not in the way you're probably thinking. When TSLX first launched, you can see it paid a typical quarterly dividend pretty consistently, but in 2017, the stock started paying a variable dividend on top of their regular quarterly dividend, significantly increasing the dividend distributions investors receive. You can also see that a couple of times in this company's history, they've also paid a special dividend. Imagine getting 3 dividend distributions in one quarter. That's what this company's been able to do a few times in their history. But you can see in the last couple of years, for almost every quarter, they've paid more than 1 dividend. This slide in their investor presentation shows that they've had a great amount of dividend coverage in the last decade. You can see for the year 2023, their regular quarterly dividend has a coverage percentage of 119% just off of net interest income alone. When you calculate net interest income along with their realized gains from their investments, this bumps their coverage up to 133%. This shows that their regular quarterly dividend is very well covered, and since BDCs are required to pay out 90% of their earnings to shareholders, you can bet that there's probably going to be more opportunities for them to pay extra dividends this year. Just one of the reasons why they've been able to pay more variable dividends is because 99% of their loans are floating rate loans. Companies that hold a lot of these types of loans, including Street Specialty Lending, Owl Rock, and Ares Capital, have been collecting more interest income during periods of high interest rates. That's because as interest rates rise, borrowers have to pay more interest to these BDCs like Street Specialty Lending. This results in these kinds of BDCs earning more interest income and being able to pay more dividends this year. With these things in mind, there's a couple things that I don't like about this stock, although none of these things would persuade me to not be an investor in them. Unlike many BDCs that avoid cyclical and higher risk investments, TSLX does lend money to these types of businesses. For example, roughly 4.9% of their debt is in oil and gas companies. They also invest in the hotel, gaming, and leisure sectors, which can suffer a lot more than other industries when the economy struggles. The good news, though, is that as time goes on, they've been increasing their debt portfolio and they've been becoming more diversified. In 2013, their 10 largest holdings made up 70% of their overall portfolio. Today, they only make up 24%. And plus, given this company's track record when it comes to picking investments, I'm really not that concerned about it. The second thing that's more like a bummer and not really a hard criticism is that TSLX is almost always overvalued. With BDCs, the best metric to look at to see if it's overvalued or undervalued is to look at their NAV per share. BDCs almost always trade around this number, and it's the usual consensus that if it's trading below its NAV per share, then it's selling at a discount, and if it's above, then it's going for a premium. TSLX currently trades for $18.71 per share, and their book value per share is $16.59, indicating that their stock is overvalued by roughly 12%. In fact, the last time this stock was trading at a discount was very briefly about 9 months ago. And historically speaking, it's been even worse. So if you're looking for an undervalued discount, then TSLX isn't there at the moment. But I would like to add that sometimes investing in a stock that's slightly overvalued isn't necessarily a bad thing. Considering this stock almost always trades for a premium, it's been delivering superior results compared to the market. Not to mention all of those additional dividends this fund pays, it's just a good example that the market is willing to pay more for higher quality stocks. In my opinion, even though I keep buying and reinvesting in TSLX even when it's trading at a premium, it's a higher price that I've been willing to pay given the results it's been delivering to me. In the end, Sixth Street is a well-managed BDC that's continued to beat the market since its IPO in 2014. I've also been loving all of these extra dividends that it's been paying out in our high interest rate environment. If you're looking for a high-yielding income stock that's also been able to beat the market up to this point, then TSLX is a stock that might be worthy of consideration for you. If you're interested, feel free to check out my Patreon where you'll find an Excel sheet of all of my holdings updated monthly. You'll also have the option of reading this analysis as well as every other analysis that I do in this series. Plus, it'll give you access to our Discord channel where we discuss higher yielding types of investments. With that being said, thank you all so much for watching today's video. If you liked what you saw, then feel free to hit that like button below and click subscribe if you want to see higher yielding investing strategy content. Again, thank you all so much for watching today's video, and until next time, take care.